This Tuesday, Nike reports earnings. Stock near a 5-year low. New CEO. The whole question on Wall Street is whether the turnaround is real. Here's the strange part. In 2024, Nike's own digital sales fell, while the wholesale partners it spent 4 years pulling away from grew. The strategy's data became its verdict. But this didn't start this quarter. It started in 2020, when Nike decided to control the consumer relationship instead of earn it. This is the hindsight. It starts not with a collapse, but with a strategy that, in 2020, looked like exactly what a modern brand was supposed to do. Nike wasn't just the biggest sports brand. It was the default. In the late 1990s and early 2000s, if you walked into a Foot Locker, a Finish Line, a Dick's, Nike was there. Not as one option among many, as the option that organized everything else around it. The Jordans were on the back wall, lit like artwork. The Air Force Ones had become a lifestyle category by themselves. The Dunks had waiting lists before anyone called them collectibles. And there was something else, something harder to quantify. When Kobe wore them, when Tiger wore them, when Michael Jordan wore a shoe that the NBA banned. Too colorful, they said, and wore it anyway. Every fine Nike paid was a headline. A billboard the press wrote for them. How do you build meaning at that scale? A billion-dollar brand isn't built on marketing. It's built on something more specific. The feeling that wearing the right shoe communicates something about who you are. So, how do you sustain that kind of meaning? You make the stores want you there. You sign athletes your competitors call reckless, then watch their careers make you look prescient. You make the swoosh aspirational in the specific way where it says something about who you are. For 40 years, Nike earned the shelf space by making the shelf space matter. By 2019, Nike had $39 billion in revenue, roughly 40% of the US athletic footwear market. At that point, what do you do with 40% of the market? You start asking a different question, not how to grow, how to control. The strategy had a name: consumer direct acceleration. To understand it, you have to understand who John Donahoe was. He wasn't a sports guy. He came from ServiceNow. Before that, eBay, 7 years as CEO of one of the world's largest direct-to-consumer platforms. He understood data. He understood how to own a customer relationship digitally. And when he looked at Nike, $40 billion in revenue, massive brand loyalty, global recognition, he saw a platform play waiting to happen. Now, the logic was almost airtight. Nike was selling its shoes through hundreds of wholesale partners who could discount them, cross-shelf them with competitors, and own the customer experience. Every shoe sold through Foot Locker was a customer relationship Nike didn't own. Every app a retailer built was data that went to the retailer, not to Nike. So what did consumer direct acceleration mean in practice? Pull back from wholesale. Invest in Nike Direct, the owned app, the owned stores, the owned digital channel. Better margins. And direct data on who was buying what. Why does data matter here? Because if Nike could track from its own systems exactly who bought the Air Force One last Tuesday and what they browsed before they bought it, it could reach that person directly next time without sharing anything with Foot Locker. Then March 2020 happened. Pandemic lockdowns hit. Digital sales exploded. Nike's app downloads spiked. For most of 2020, a consumer direct acceleration looked like a vision statement that had predicted the future. Was Donahoe wrong to believe that? No. He was reading a real trend. He just couldn't see where it ended. Spring 2022. Physical retail came back. Not slowly, suddenly. After 2 years of pandemic digital shopping, people wanted to browse, touch things, walk out with a bag. And when they got to Foot Locker, to Dick's, to the athletic section of Macy's, they found something they didn't expect. A little less Nike than they remembered. Why did Nike have less presence? Because Nike had been building toward this not mattering. The consumer direct acceleration had pulled investment away from wholesale partners, not cut them off, but reduced their relative priority. The plan was for consumers to find Nike directly. And what nobody had modeled was this: the retail shelf is not a warehouse for products people already decided to buy. It's a discovery system. How does a discovery system actually work? A first-time buyer walks in with a loose idea, maybe running shoes, maybe something new. They reach for what's in front of them. They listen to whatever story the salesperson can tell. That encounter sets their brand preference, sometimes for years. On didn't need to outspend Nike to win that customer. They just needed to be present when Nike had decided it didn't need to compete for that shelf. And what happens when two brands fill that space for 4 years straight? On builds a credibility base. Hoka builds a credibility base. They become the default for a set of consumers who never made a deliberate choice to leave Nike. Nike just wasn't there when they were deciding. And to be clear, this is not what a dumb decision looks like. This is what a smart decision looks like when the model it was built on shifts. It was exactly the right move on a spreadsheet, and it was exactly the wrong move on the floor. So, what did the numbers actually show? But here is the math that actually confirmed it, and why the company had no choice but to call it by name. By 2024, Nike had 4 years of data. And the data did something surprising. It sided against the strategy. In Q4 of fiscal year 2024, Nike Direct, the owned app, the owned stores, the digital-first channel, declined 8%. Nike Brand Digital declined 10%. And wholesale? Wholesale, the channel that Nike had been pulling resources from for 4 years, grew 5%. The system Nike had been optimizing away from was the one that held up. Now, there's a detail here that almost nobody focuses on. While Nike was reducing its reliance on wholesale partners, those partners had to respond. Foot Locker, which had historically relied heavily on Nike product, now had a business reason to find and develop other brands. Which brands got that attention? The exact brands that would go on to compete with Nike for shelf space. On, Hoka, Adidas. So what was going wrong on the direct side? Part of the problem was the product itself. Nike had been leaning on its classics. The Jordan 1, the Air Force 1, the Dunk. Reliable, recognizable, proven. But the classics had been oversupplied. Oversupply drove markdowns. Markdowns weakened scarcity. And for Nike, scarcity is not a luxury concern. It is the product. A swoosh on markdown is a different swoosh. And then, it gets worse. In China, a market Nike needed to grow, not fix, the challenge was different in kind. Anta and Li-Ning weren't winning on price. They were winning on cultural fluency, in a market where global brand power didn't automatically translate to local relevance. By Q2 of fiscal 2026, Greater China was down 17% year over year. At what point does the board stop calling it temporary? September 2024, Donahoe exits. Elliott Hill, 32 years at Nike, former president of the Consumer and Marketplace Division, becomes CEO. The December turnaround plan is public, and here is what it says Nike needs to rebuild: sport focus, innovation, marketing investment, wholesale partner trust. 5 things, each one of which had been quietly reduced by the previous strategy. Hill's turnaround wasn't a new direction. It was an itemized receipt of what the strategy had cost. Which means the strategy worked, just not for the company. Donahoe's team didn't make a reckless bet. They made the most rational decision available to them. Higher margins, better data, customer ownership. These are the ideas every consulting firm would sell. Every MBA program teaches them. Cut the middleman, own the relationship. So why didn't it work? Because cool is not a product you can ship direct. It lives in a moment you don't control. The moment a stranger walks into a store they didn't plan to visit, reaches for something they didn't know they wanted, and decides in the next 30 seconds that this is what they need. You can't own that moment from headquarters. You can only be present for it or absent from it. Nike spent 4 years making itself absent. The danger for any dominant brand is not losing to a better competitor. It's convincing yourself that your advantage is so durable, you no longer have to earn it. Every day, in stores, on fields, in the moment where a stranger decides what they want to be seen wearing. This is the part of the story that haunts me. The fix reveals the mistake, and the mistake is this: cool is not inventory. On June 30th, Nike reports again. What investors are watching is whether the numbers prove the turnaround, whether wholesale trust can be rebuilt, whether sport credibility can be reclaimed in 2 years. But the more interesting question, the one this story answers, is whether the company has actually understood what it lost. Not market share, not revenue, inevitability, the feeling that wearing the swoosh means something. If this is the kind of story you come here for, subscribe. There's a new one every week.